Hey, welcome to another Mortgage Minute. My name is Jeff Harrison, and it is Thursday afternoon at 2 p.m. on the internet on the West Coast. And, life is like a river. Every time we step into it, it's different. And sometimes we want to make sure when we step in that river that we don't step on anything that will puncture our foot or tear our shoes. So we have an expert guide when it comes to everything mortgages that will be our guide to make sure that we don't step on anything sharp. And we want to welcome today's expert guest, that is actually our host, Art Alvarez. Art, welcome to today's show. Are you ready to guide us through this tumultuous times?
Yeah, sure. I'll try to do that. Hi, Jeff. I'm looking around for the river I'm going to step into, but I'm sure there's one around here. Well, there was one around here a week or two ago with that hurricane. So,
geez. Well, it doesn't seem like that. Is every time we turn on the news, we check our apps, it seems like the conditions have changed.
Yep.
Yeah,
that is true. Yep.
I mean, in your industry, in the industry of mortgages, I mean, are we better to have this kind of activity, or are you looking for that? Hey, you're looking for that lake you can step into?
No, I mean, this kind of activity is fine. The mortgage industry is one that certainly is pretty cyclical, and things are changing all the time. And, you have to pay attention to that. And of course, that's a lot of what we do is pay attention to what's going on in the industry, and with the right products and options, we can serve our customers well.
Well, before I let you go, let me just remind everybody that this is a live show. It's called Mortgage Minute with Art Alvarez. He is our expert with over 4 decades of knowledge in this industry. He's seen it all. He's seen every curve in the river, and he can help us through that. But before I go, I want to remind you, because it is a live show, please feel free to put your comments in the section, whether it's in Facebook or YouTube. I'll be manning that area, and I'll be feeding them back to Art, and he'll be answering those questions live. And if you are catching this on the second go around, then please just put your questions in there, and Art will be sure to take care of it. Art, with that, I'm going to step aside. Let's have a great show.
Okay, thanks, Jeff. Hello, everyone. Art Alvarez at Mortgage Works, where we do have the answers, and they're on the house. Welcome to this week's Mortgage Minute. As you probably know by now, if you're a regular viewer, what we'd like to start off with is giving you an update on where the mortgage market is in terms of interest rates and bond yields. So let's jump right into that with this week's mortgage rate update. And of course, in doing that, one of the things I'll direct you to is our website. Right on the homepage, we post a rate grid that gives you interest rate, what I call indications. And I say that because obviously these rates that are posted are based on certain assumptions. In fact, if you go to the bottom of the rate grid in the box, I go into more detail about how mortgage rates are determined. But this gives you a general idea, a good idea of where rates are right now. And again, despite the news media talking about we're back in the sevens, this week, of course, bond yields did move up to where we're pushing sevens again, but I still have a fair amount of conforming product that you can still get under 7%. So in terms of these rates, what's been going on with the bond market? Well, Jeff is going to pull up the 5-day chart of the 10-year bond. I've always say that's your best barometer to check the direction of mortgage rates. And what we saw last week, the bond yields actually were settling down, was getting pretty optimistic. We were looking at around 4.10 going into the end of last week, the beginning of the Labor Day weekend. And of course, right before the weekend, the yields did jump up a bit, which is not uncommon before a holiday weekend. And then after the holiday weekend on Tuesday, the bond yields opened up, and of course, quite a bit elevated up to that about 4.25 range. So what was going on this week in terms of economic data or data points that may have caused some of this week's changes? Well, on September 5th, a couple of days ago, that's on Tuesday, we did have factory orders come out. They were minus 2.1 versus minus 2.3 forecast. Not much of a market mover there. But the big number, the one that really has gotten our 10-year bond yields elevated again, is the ISM Services Index. That's Institute of Supply Management Services Index. So this is a data point that basically monitors the service industry in the U.S., the service economy. And this number this week was extremely high, or at least much higher than forecast in a relative sense, 54.5 versus 52.5 forecast. So this was considered a super hot number. And further, it was the 8th consecutive month of service sector growth. So what this suggests is that the service economy, anyway, manufacturing is another story, but the service economy in the U.S. is pretty darn robust. It's pretty strong. And so with 8 consecutive months of growth in the service sector and this super high number this week, that spooked bond traders, and that's why you're seeing that 10-year bond yield back up over 420, then 425. In fact, frankly, toward the end of the day yesterday, we were looking at about 430. So it jumped back up quite a bit. And then, of course, today we did have initial jobless claims. 230,000 was forecast. Turns out the idea that the labor market is strengthening. So again, some mixed signals here. And then U.S. productivity was forecast to grow by 3.4%. It actually came out slightly above that 3.5. So interestingly, we've got some pretty strong data points here in terms of economic strength. I think that is helping keep these bond yields a little bit more elevated. But the good news, at least today, when you go back and look at that chart that Jeff just showed, the bond yield today is dropping. We're getting back closer to 4.25. So that's good news. And that should help get us more firmly back into the sixes for conforming mortgage rates. So there's your mortgage rate update. Next, I want to go into, and again, this is going to sound like I'm becoming a weekly Dave Ramsey critic, but as I've mentioned, Dave Ramsey seems to be in the news a lot. I see his name and his articles with his name on it in a lot of the news feeds. And so yet again, I saw a news headline regarding Dave Ramsey that caught my attention, and I just couldn't resist wanting to address it on the show today. So here's the headline: Ticket to Foreclosure. Dave Ramsey warns of this mortgage trap he calls dumber than a rock on the surface. Well, of course, I see that. I'm curious. I dived into the article to find out what he was talking about. And of course, I had a sense that I probably knew what he was talking about. And sure enough, he was referring to ARM loans. That's adjustable rate mortgages. And so this article was highly critical of ARM loans. And as you can see, Dave, in some respects, was essentially like criticizing borrowers who would consider getting an ARM loan, questioning their intelligence. Well, part of what I want to do here is maybe give you some alternative perspective on that and let you know that, at least for those of you who've gotten an ARM loan, either in the past or even recently, I'm going to defend you. I'm going to suggest you're not as dumb as Dave might think you are. First of all, now, what is Dave's concern? Well, Dave's concern is that there seems to be a little bit of an uptick in popularity of ARM loans. And of course, in Dave's opinion, and I'm giving you some bullet points here of his thoughts on ARM loans in general, he calls them a ticket to foreclosure rather than to home ownership. And then he brings up in the article that there was a question posted on the Experian website. Experian, of course, one of the U.S. Major credit bureaus. And on this Experian site, there was a question posted: can ARM loans help people purchase a home? Now, interestingly, Dave's reaction to that was to be suspicious. He was suggesting that Experian putting that kind of question on their website was they were doing so out of a vested interest because they're trying to promote ARMs, and to the extent people are convinced to go with an ARM loan, that's going to increase mortgage applications, which is going to increase credit scores getting pulled, which is going to make Experian some money. Sounds a little bit conspiracy theory-like, so I'm not sure I would go that far, but he did seem to think that that may be why Experian was even posting the question. And he goes on to mocks getting an ARM loan when rates are in a current, like we are now, rising rate environment. He mocks, the idea of getting an ARM loan when rates are rising. And that's where he came up with calling that it's dumber than a rock on the surface. And I think part of what he was reacting to is there was at least one survey out there that says as much as 40% of Americans are willing to get an ARM loan. And of course, Dave's response to that is ARMs are bait and switch. And part of the reason he believes is because they are assigned to an index. That's true. An ARM loan is going to be tied to a particular index. Right now, we're using what's called SOFR. And that index is going to have a margin added to it. And when you get an ARM loan, yes, it's true. That index plus the margin will usually mean a what's called fully indexed rate that is going to be higher than the start rate on the ARM loan. But that's not necessarily bad, and I'll come back to that in a minute. The other thing he suggests is that ARM loans adjust upward more rapidly, but adjust downward more slowly. I'm not sure I would buy into that. They're tied to an index. The index rises and falls all the time. There's nothing implicit in the index to suggest it's going to rise quickly but fall slowly. So I'm not sure I would accept that argument. And then he kind of finishes his commentary on ARM loans to suggest that they rank right up there as the most significant financial trap ever devised. So pretty strong works from Dave Ramsey on a mortgage product that's been in the industry and pretty well accepted for at least the last 30 years plus. So I'm going to attempt to defend Dave's dumb as a rock ARM borrower description. And one of the things I'm going to start off doing is pointing out that when you read the article, it admits that much of Dave's skepticism comes from his experience of the 1980s, including the S&L crisis that led to the creation of ARM loans to start with. Now, I can relate. I was in the industry in the 80s. I got into the industry in the very early 80s, 1982 January to be specific. So I had a front row seat to all of what Dave remembers and what has led to his skepticism about the ARM loan product. I was there. I saw it. Now, it's true. Early on, some of the ARM loans devised were not that well designed and didn't have adequate safeguards for the home owner, for the borrower. So I'll give him that. That is true. But the product has evolved quite a bit over the years. Now, where I think I would agree with Dave that a borrower can be considered dumb as a rock is if you think back to, which I'm sure Dave is thinking about, the old option ARMs. If you remember, that was the ARM product that was very popular in the early 2000s, in which many believe led, or at least helped lead us to the big 2008 mortgage and real estate market crash. Now, the option ARMs were a product that in hindsight were not very well designed. They featured a very low teaser rate. They adjusted monthly. They didn't have an adjustment cap. They had an annual payment cap. These loans negatively amortized, and they were set up not just on a 30-year, but even a 40-year amortization. And so for all those reasons, that was a loan that really, truly was not well designed and did put a lot of homeowners into some financial trouble. So to the extent Dave's concern about ARM loans is couched in that old product and the initial creation of ARM loans and early design of ARM loans, then yes, I'll give him that. However, as I said, things have evolved. And in fact, talking about that evil option ARM in particular, that product is gone. It was effectively regulated away by the Consumer Financial Protection Bureau after the big crash of 2008, when the new regulatory environment for the mortgage industry and the ATR rules, that's ability to repay rules, were created. And part of those rules was to eliminate risky features out of certain conforming loan programs, like 40-year amortization, prepayment penalties, negative amortization, and so forth. So today's ARM loans don't have any of that. And in fact, today's ARM loans are really what we consider hybrids or fixed ARMs. The most popular ones have a fixed introductory rate and payment period. That's introductory rate and payment period fixed, ranging from 3 to 10 years. So not monthly, not for 6 months, not for a year, fixed payment, fixed rate for 3 to 10 years. That's why we call them a hybrid ARM or a fixed ARM. These loans are designed for the borrower who wants to try to get a break on the interest rate over a 30-year fix, but probably have an intention not to keep the loan past that initial fixed rate period. And to that extent, I would say it's the 7-year ARM, the one where the rate and the payment are fixed for 7 years, that proves to be the most popular. It gives a nice extended period of time where there's no adjustments. And in most cases, a homeowner has a belief that within that 7-year period, they're no longer going to own the home and they're probably going to refi. The point is they don't intend to keep it past that end of that fixed period. The other thing I would note is ARM loans are not really utilized much by low to moderate income borrowers, first-time home buyers and borrowers. The reason is that ARMs are generally not competitively priced well for conforming loan amounts. Remember, our conforming loan amount in the U.S. this year is $726,200. So if you're looking to get an ARM loan at that loan level or below, that's a conforming loan amount, most any lender is not going to have those priced very well. Why? Because the end investor, Fannie Mae and Freddie Mac, do not price ARM loans very well. So you don't see much conforming loan amount ARM loan originations going on simply because the rates on those, frankly, are no better than 30-year fixed in most cases. Where the where the ARM loans do have some interest and where there is more activity, it's in the jumbo category, loan amounts over $726,200. That's where you're going to see more use of ARM loans. Of course, we're talking about much higher loan amounts, higher property values, higher income, higher net worth borrowers, many of who are financially savvy and are a little bit more tuned in to how the ARM loan works, and they're a little bit more strategic about deciding to use that product in a scenario where they don't think they're going to keep it past the fixed period. So in that regard, I would argue that considering an ARM loan is actually a financially and from an intellectual standpoint, a wise thing to consider. If you know you're going to be acquiring a home and you don't think you're going to have it past 5 years, why get a 30-year fixed, and we're talking about a jumbo loan here, why get a 30-year fixed loan at 7% when you can get a 7-year ARM at 6.5% when you pretty much are certain you're not going to have that loan after the 7-year fixed period? Why wouldn't you take advantage of that 0.5% increase, the 0.5% lower rate, that 0.5% benefit in the rate in terms of your monthly payment? That would be the logical, rational thing to do, not a dumb as a rock thing to do. So there you have it, Dave. That's my counterpoint to your article about using an ARM loan means you're dumber than a rock on the surface. I would say in many cases, in fact, most cases, I would say that's not true. And your concern about ARM loans are based on how they used to be. But that was then. This is now. ARM loans are a much better product, and I'm happy to offer them to the right borrower for the right situation as long as they're fully explained and they know what they're getting into. Okay, so that's it on ARM loans. They're not the boogeyman. They're a good product in the right situation. And with that, I want to move back into our next subject, again, with something I've talked about quite a bit lately. I'm going to keep talking about it because, frankly, in the mortgage industry is probably the area of most activity right now, and that is home equity loans and how to tap into your home equity. So in that regard, I'd come across an article also published in the week, this week, or actually last week, August 31st. And the article said, when does it make sense to borrow against your home's equity? Well, again, if you've been watching this show, you know I've been talking about this quite a bit. But the basic gist of the article is, if you're going to look at getting some of your equity out of your home, if you're going to pull that out, you want to consider what your plan is, which of course means you should have a plan. And is there a long-term benefit? And I'll come back to that in a second. Some interesting stats, current stats, second quarter 23. HELOCs and HELOCs jumped by 53% and 21% respectively in terms of applications. So that's a big increase in both fixed rate seconds, that's what a HELOC is, and variable rate seconds, that's what a HELOC is. So big improvement in activity for both. Certainly a much greater rate of improvement over first mortgages right now. The biggest reason, reno or renovation. That is leading the interest in equity loans driven by lots of homeowners who are in a locked up real estate market that cannot give up, don't want to give up that 2.5% mortgage. They got a lot of equity, and instead of selling their home and buying a bigger, nicer, they're going to take some of that equity, improve their current home, and stay put. The other big issue is debt consolidation. That's probably the number 2 reason people get equity loans. And that's driven by credit card debt, now over $1 trillion in the U.S. So that's the second biggest reason for tapping your home equity. And does it make sense to tap your home equity for these 2 reasons? I would say yes, with some qualifiers I'll mention in a minute. Pros to getting an equity loan. They're generally going to have better rates than unsecured loans. Unsecured credit cards for sure, unsecured personal loan, they're going to have better rates. Flexibility. Well, that's true with the HELOC, not the HELOC. HELOCs are very popular because of the flexibility. Draw on the account, pay it down, draw on the unused portion again, pay it down, draw again. You can do that with most HELOCs for up to 10 years. Plus the fact, because it's a secured second mortgage on your home, you may have potential tax benefits. Check with your tax advisor to confirm, but you certainly have that potential over an unsecured loan. The cons of equity loans: borrowing costs. You can see some closing costs on equity loans and HELOCs, both in terms of limited escrow and title fees, appraisal fees, although in those cases, most of them are automated valuation appraisals, so their costs are very low. You could see some origination fees on HELOCs depending on which rate option that you choose. Loss of home. It's a second mortgage. It's secured by a home. If you don't make the payments at the extreme, you could lose your home through a foreclosure because it is a mortgage. So you want to keep that in mind. And of course, the risk of rising rates. If you're on a HELOC, that is a risk. Most folks getting a HELOC right now are taking a bet that they think HELOC rates are going to pause and maybe start falling because they think the Fed is near the end of their strategy of raising the Fed funds rate to fight inflation. So when is an equity loan a good idea? Well, the first thing I would tell you, and it's mentioned in this article, don't use it for unnecessary expenses or vacations. A lot of times with a HELOC, you'll get essentially a debit card. Don't use that for dinner out. Don't use that for groceries if you can. I mean, it's just not a wise use of the funds. You want to remember, you want to have a plan, and you should have a long-term benefit. So short-term unnecessary expenses or vacations, things like that, generally not advisable to use a HELOC for that. Because again, you're putting that debt on your home, and it could take you a while to pay that off or pay it back. So for certain expenses, it doesn't make sense to do that. Paying off short-term debt is a good thing. And of course, most of the time that's credit cards. But with that, you should combine that with a commitment. I say a commitment to avoid short-term debt again in the future. So if you're going to use a HELOC to pay off a lot of money in credit cards, great idea. You're going to save a lot of money in interest on a HELOC rate versus your credit card rates, but really change your behavior and avoid getting those credit card balances back up again in the future. Otherwise, you've wasted your home equity on paying off short-term debt. That debt comes back, re-arrives, if you will. You're back in the same boat, and you could eventually run out of equity to keep doing that. And so you want to avoid that process to start with. If you're paying off credit card debt, figure out a way to put those credit cards in a drawer and avoid using them as much as you can. And again, use the funds for tangible long-term benefit. If you've got a minor repair at your house, try to avoid a HELOC if that's what you've got. The way I think about it is, if you're going to use a HELOC, use it for something that's going to be long-term, improvement to your house, or maybe in some sort of investment that's going to give you a return in the future. I also often say that a HELOC is like a credit card, but I'm going to suggest, yes, it's like a credit card in terms of how the program works, the structure of it, but don't use it like a credit card. Don't use your HELOC debit card for all kinds of little expenses just for day-to-day living. That's going to get you in trouble. So they're like a credit card, but don't use them like a credit card, to that same degree that credit cards tend to be used. Okay. So with that, kind of reminder again about home equity loans and the fact that they're very popular right now. I'm going to jump into the next subject, which is I have a new home equity loan product, another HELOC product that I want to share with you. And it's an exciting program. It's a little bit different. This one is going to appeal to someone who looking to tap into their equity. They have a really specific need. They have a specific amount of money. It's going to be probably more of a one-time use, like maybe a major home improvement project, like a kitchen remodel or installing a pool. Not necessarily something you're going to look at using time and again over the next 10 years. And most importantly, this program, it's a lot different because it's fully automated, fully online process, and you can actually get the loan in as little as 5 days. And the way this works is an eligible borrower is going to be able to access their home equity and get a line of credit. And it's available on single unit properties, either owner occupied, a vacation or second home. And most importantly, and this is rare, on a rental property. But again, a single unit rental property, no 2 to 4 units. So no duplexes, triplexes, fourplexes. Sorry about that. Now, the repayment period for this particular program ranges. You can choose as little as a 5-year term up to a 30-year term. You choose that as part of the application automated process because you're going to get proposals, and then you choose which term you want. And then depending on which term you choose, you will then get a draw period that's going to range from 2 to 5 years depending on the loan term. So if you only choose a 5-year loan term, you're only going to get a 2-year draw period. If you want a 30-year loan term, you'll get a 5-year draw period. So that, again, is going to vary depending on what loan term you select. You get all the money at once. So this is not like some HELOCs, the other HELOCs I offer, where when you get the loan, you can you do have to meet the minimum draw amount, usually $50,000, but you don't have to draw more unless you want to. But this HELOC doesn't work that way. You have to take the full amount of the line of credit that you want. You have to take the full amount at closing. Again, you don't need it all at once. You can send the excess portion back, and you'll pay it back toward the loan. There are zero costs on the loan. Now, let me clarify that. Zero cost meaning there's no appraisal fees, title fees, that kind of thing. You will have an origination fee depending on the rate option you choose. Again, you're going to be given a proposal after you submit an application online that will give you the program interest rate and origination fee option. So you could have an origination fee, but literally virtually no other closing costs that you normally see associated with getting an equity loan. There's no prepayment penalty. There's no title report obtained on your property, which is a little bit different than most HELOC programs or equity loan programs. It's a fully automated underwriting and appraisal process. Again, fully automated. You apply 100% online. We can get the loan approval in as little as about 5 minutes. Maximum line of credit amount is $400,000. And for most applications, you only need a government issued ID. Now, why would that be? Well, again, it's automated. For a borrower, a homeowner who is maybe employed and with a company that is a major company, these days it's quite possible to get verification of employment and your income through an automated process. Same with your bank accounts. So with that kind of automation available to be able to, in an automated way, verify your employment, your income, and your assets, that can dispense with having to provide pay stubs and W-2s and tax returns and bank statements. So in a lot of these transactions, not all, but a lot of these transactions, you may find that you have nothing to provide except your government issued ID. So it's very streamlined, very quick, works a little bit differently than the standard HELOC, but it can be a great option for somebody who just needs the money, knows what they want, knows what they're going to use it for. They're thinking it's going to be probably more like a one-time use. This is a great way to apply online, minimal paperwork, fast approval, and most importantly, a very fast closing. So want you to be aware of this. If you want more information, feel free to contact me. Be happy to send you some numbers or give you more detail about the parameters and underwriting criteria for this new HELOC program that we're pretty excited about. Okay, so with that, that's it for equity lending this week. Now I'm going to go ahead and go into our closing question from last week. And for that question, if you may recall, I'll read it to you again. I'm a renter looking to purchase a home for $600,000. Of course, that presumes that you're, as a renter, you're, possibly going to be undertaking this loan, and you're going to be probably thinking about tax benefit, right? So therefore, the question: how can I determine the tax benefits of purchasing the home? Well, we can help you with that. And the best way to answer this question: go to our site. On our website, we have a whole page of calculators. And one of the ones on there, which I think is a great calculator, is called Tax Benefits of Buying a Home Calculator. It's at mwloan.com. Go to that page. You can pull up that calculator, and you do have to input a few things. Enter your loan parameters, such as your purchase price, your planned down payment, and what month you think you're going to be closing the transaction. You would input the interest rate and points, if any. The reason you would input points if you're thinking about paying points is, and check with your tax advisor, on a primary residence purchase, if you pay points, if you check with your tax advisor, you should find that those points may be fully deductible in the year that you paid them. So that's why you're going to input not just an interest rate, but if you're contemplating paying points, put that in there too, because that can affect how much of a tax benefit you can get. You'll also have to estimate your federal and state income tax rate. So depending on where you live, and of course we do business in California, you would put in the what you estimate your federal tax rate to be based on your income, and what your state income tax rate would be here in California or whatever other state you're living in. When you do this, the interest payments and points, if you're going to pay any, are captured into the itemized deduction number that's on the calculator. So what you'll be left to do is, if you're thinking you're going to itemize your deductions, you're going to be asked to input any other Schedule A deductions that you plan on declaring. So you would input that into this calculator. And then what the calculator does is it's going to compare itemized deductions approach versus standard deduction approach, and then give you a bottom line net tax benefit calculation or number, tax benefit for tax benefit for purchasing the home. And I played around with this using the $600,000 price level with a 10% down payment. And what I was coming up with is somebody who's renting currently, and who goes down this road of buying this home for $600,000. And of course, I made some assumptions about income tax rates and so forth. The tax benefit was going to be somewhere in the $500 to $600 a month range. What that would mean, therefore, is if you're paying $3,200 a month in rent, if you're looking to buy a $600,000 home, well, that tax benefit of buying that home may essentially be to the tune of, say, $600 a month. Well, that effectively means even if the housing expense on the home you're buying is not $3,200 but $3,800, it's roughly equivalent to what you're paying in rent now, which would be a reason why stop renting, go buy the home, because at least that way you do get that tax benefit, and you have the opportunity, not the assurance, of increased equity in the future if that property increases in value. So take a look at that calculator. It's a great tool if you're a first-time home buyer and you want to get an idea how much of a tax benefit you're going to get from financing a home purchase. That's where to go, mwloan.com. Look for our tax benefit of purchasing a home calculator and do the math. With that, let's go to our closing question for next week. And with this one, I think it's actually kind of timely and something that I've encountered a few times here recently. So here's the question. Can a no cash out refinance be used to buy out the ownership interest of another title holder? Again, can a no cash out refinance be used to buy out the ownership interest of another title holder? Well, contemplate that. Stay tuned until next week, where I'll provide you the answer and it'll be on the house. Jeff, back to you.
Art, I'm so comfortable now because I feel like you have taken the white caps or the whitewater off the creek, and it's easy to step in and avoid. I'm excited about this whole program you have going on for home equity line of credits. I mean, if somebody needs some fast responses, fast results based on the program, you said, hey, is it a good time to get a home equity line of credit or to use your equity? Boy, this seems like that would be the program. And we go right through Mortgage Works to get that done. Yes,
we're originating those now. In fact, just yesterday I was talking to a homeowner, owns a couple of homes actually, and his interest is in his rental property. He actually lives here locally in the Coachella Valley, but he has a rental property in LA in the San Fernando Valley. It's worth about $1.5 million. And what's piqued his interest with this product is because of the fact that it's available for rental property. Equity loans for rental properties are more rare. There's not a lot of lenders who offer them. I have two other HELOC lenders that we deliver HELOC loans to. Neither one does rental property. They don't do them. It's primary home or second vacation homes only. So this program is exciting because I get a fair amount of inquiries about a HELOC for a rental property, and this is going to allow us to meet that need. We already did have equity loans, fixed rate loans for rental properties. We've had that for some time, and we still do. But HELOCs still, even though fixed rate seconds are gaining in popularity, HELOCs are still, I would say, still have the edge. People want those HELOCs because of the flexibility.
I think it's a great opportunity. Well, hey, if some of this resonates with you and you're thinking, just like Art said, hey, I'm an investor, which in the past, if you were an investor, you couldn't really get the equity out of your home unless, like you said, you had a second or you sold your property. And sometimes, that defeats the purpose of having investment property. So this is a great opportunity. Make sure to reach out to Art at 760-883-5700. Of course, you can always get him on that instant Art phone at 714-612-9035. I think he even does laps when he's swimming with that in his pocket. So it's waterproof and
Flips.
It's ready. It's what?
I do flips. It's a flip phone.
It's a flip phone. That's right. When he's doing dive practice. That's right. That's right. And of course, you can always go to his website at mwloan.com and check out those calculators and see about the savings you might see. There's a lot of different calculators. I think you have like 12 or 14 calculators on your website for different things. Yeah, it's a great resource. So make sure you go there. And of course, you can always get together Art at mwloan.com. Art, any last thoughts before we let you go? I suspect the phone is going to start ringing because of this program that you've just introduced.
Yeah, I think so. I mean, certainly keep that in mind. Equity lending is sort of the big push right now in the industry. It's the area where I think there's lots of opportunities. So that's why we keep talking about it. We're excited about this new HELOC program. It gives us yet one more tool, one more option for homeowners. So I would certainly say for any homeowner who's contemplating tapping into their equity, give me a call. Be happy to have a conversation with you. Talk about the pros and cons, the pluses and minuses, and help guide you to the right solution. That's what we're good at, and we look forward to doing that with as many homeowners as we can. So,
hey, skip the office call. Call him on his flip phone while he's doing backflips in the pool at 714-612-9035. Excuse me. And he will get you squared away. There's a saying: when one door closes, another one opens. When the rates go up, there's other options, and Art has them for you. Art, have a great week, and we'll see you next week.
All right. Thank you, Jeff. Thank you, everyone. Thanks for listening. Thanks for watching. This is the conclusion of the Mortgage Minute for this week. I'm Art Alvarez at Mortgage Works, where we do have the answers, and they're on the house. So long. Take care.